Hello, everyone, and thank you for joining us. Today, we're going to talk about a subject that is often surrounded by legal jargon, tax terminology, and more than a few misconceptions. How trust can help families avoid probate, reduce taxes, and transfer assets with greater privacy and control. Before we begin, I would like you to consider one question. If something happened to you unexpectedly, how confident are you that your family could carry out your wishes without unnecessary delay, expense, conflict, or confusion? You don't need to answer aloud, just simply give yourself a number from 1 to 10. A 10 means my documents, ownership structure, beneficiaries, trustees, and tax strategy are fully coordinated. A 1 means I'm not certain what would happen. Keep that number in mind because by the end of our time together, you should have a clearer sense of where your plan is strong and where it may deserve attention. On a scale of 1 to 10, how coordinated is your estate plan today? Write your number down and keep it in mind throughout the class. Here are the key disclosures for this class. This program is educational and is not a substitute for individualized legal or tax advice. Because trust laws vary by state and the right strategy depends on your assets, family goals, and existing documents. Feel free to pause to read through these, but for more disclosure information, visit the disclosure webpage listed here at the bottom. Here's a little bit about myself. My name is Kelly Bufink, and I was born and raised in Texas. I've been a financial advisor since 2001 and I hold a CFP designation. I have a bachelor's in psychology and English from the University of Maryland University College, and I'm an Army wife of over 30 years. In my free time, you can find me with my husband and my 2 dinosaur of dogs and my 4 children. And of course, we visit them throughout the country. Here's a little bit about the firm. We are Strip Matter Wealth Management Group. We were founded in 2007 and we are comprised of certified financial planners and fiduciaries. Education is our passion and we specialize in comprehensive financial planning, including estate planning and trust strategies to help grow wealth across the generations. Since education is our passion, here's a look at just a few of the free resources we provide. All are located on our website at stripmatterwealth.com, and our goal today is not to persuade you that everyone needs the same trust. It's to help you uncover whether there's a gap between what you want and the plan you currently have. That leads us to the outline for today. Why strategic trust planning matters, avoiding probate, minimizing taxes, protecting your legacy, and turning today's knowledge into action. Today, we'll walk away knowing how to explain the different ways trust can help your assets transfer more efficiently, privately, and avoiding probate, distinguish difference between the revocable and irrevocable trust, and identifying the advantages of each, and finally, learning how to coordinate trust strategies with other parts of estate planning to see how it impacts your broader financial goals. So, what do you want to get out of today's class? Take a moment and write down your personal learning goals for today, and feel free to pause here to give this meaningful consideration if you'd like. So let's get started. Our first section covers why strategic trust planning matters today. We'll look at the hidden costs and complications of an uncoordinated estate, how trust can support your privacy, control, and tax efficiency, and the essential roles of your attorney, tax professional, and advisor. Most estate planning problems do not begin because a family failed to care. They begin because ownership, beneficiary designations, and legal documents, financial accounts were all created at different times by different people and were never brought together in one cohesive plan. Perhaps your will was signed 15 years ago, but your retirement accounts were updated later. Perhaps you created a trust, but the house or investment account was never transferred into it. Perhaps one child was named as the executor and another as power of attorney, and no one explained how those rules should work together. The result could be costly at best and disastrous at worst. The 5 hidden costs of an uncoordinated plan include probate costs and delays, public filings of your private documents, avoidable family tension, unexpected taxes, or assets passing to someone other than whom you intended. The painful part is that many of these outcomes are not caused by a lack of wealth, they're caused by a lack of coordination. A trust is a legal arrangement in which one party holds and manages property for one or more beneficiaries under written instructions. That sounds simple, but trust can be designed for very different purposes, including avoiding the costs and delays of probate, maintaining privacy and continuity, keeping control in case of incapacity, and reducing and avoiding unexpected taxes. Trusts do require proper design and implementation, which we will go over. Let's review two types of trust: revocable and irrevocable. A revocable living trust is commonly used to support probate avoidance, privacy, incapacity planning, and continuity of management. Because the person creating it retains control and can amend or revoke it, it usually does not remove the assets from that person's taxable estate merely by existing. An irrevocable trust may be used for estate tax planning, asset protection objectives, charitable planning, life insurance planning, or multi-generational transfers. But those potential benefits often require giving up some degree of control and access. The first principle to remember is this: the word trust is not a strategy by itself. The type of trust, the assets transferred to it, and the powers retained, the timing, and the administration all matter. For families with $1 million or more in assets, the strongest results often come from a coordinated team. The estate attorney drafts your legal structure, the tax professional evaluates income, gift, estate, and capital gain consequences. The financial advisor helps align your investments, insurance, retirement accounts, cash flow, ownership, and beneficiary designations with the legal plan. As we move through today's material, listen for the questions you may need to bring to your own professionals. The objective here is not to leave with a trust selected from a menu. The objective is to leave knowing what strategies may be right for your unique situation. Now we'll transition to avoiding probate, creating a faster, more private wealth transfer, which includes understanding probate, its costs, delays, and public exposure, how a revocable living trust transfers assets outside of probate, and funding your trust, the critical step many families overlook. Probate is the court-supervised process used to validate your will, appoint a personal representative, address creditor claims, and distribute your probate assets. The details, costs, and timelines vary considerably by state and by the complexity of your estate. Probate is not automatically a catastrophe, though. In some situations, court supervision might be useful. But for families with significant assets, multiple properties, a family business, complex beneficiaries, or a strong desire for privacy, probate can introduce friction at exactly the time your family is least equipped to handle it. Consider what information of yours may become public: your will, certain asset inventories or accountings, petitions, notices to creditors and the government, and other court filings, each depending on state law. Now consider the practical burden: locating the documents, securing the property, valuing the assets, coordinating with beneficiaries, paying expenses, and waiting for the courts to act. The financial cost is only part of the issue. There's also a rather steep emotional cost. Imagine a surviving spouse or adult child trying to manage grief while learning a legal process, responding to family questions, and making decisions under pressure. Here's a question to consider: if your family had to spend months untangling ownership and court requirements, what would that cost them in time, confidence, and privacy? This question is not intended to create fear. It's meant to reveal whether probate exposure is a risk for your family. Not every asset passes through probate, though. Assets may transfer outside of probate through several mechanisms: joint ownership with rights of survivorship, beneficiary designations, transfer on death or payable on death arrangements where available, and properly funded trusts. Retirement accounts and life insurance proceeds follow their beneficiary designations instead of the instructions in your will. That's why an old beneficiary form can override a beautifully drafted estate plan. Joint ownership can avoid probate at the first death, but it could create tax, creditor control, or family equity issues. Transfer on death registrations may be useful for straightforward transfers, but they might not provide ongoing management and protection or conditions for your beneficiaries. A trust is valuable not only because it changes where an asset goes, it can also define how, when, and for what purpose the asset may be used. With a revocable living trust, the person creating the trust, often called the grantor or settlor, typically serves as the initial trustee and beneficiary during life. They can generally buy, sell, invest, spend, amend, or revoke the trust assets according to the document and the applicable law. If you become incapacitated, a successor trustee can step in under the trust instructions, often without requiring your family to seek a court-appointed conservator for the trust assets. At death, the successor trustee can administer and distribute the trust properly and privately, subject to applicable law. The benefit here is continuity. The legal owner of the trust property has not disappeared. The trustee responsible for managing it has changed. For a family owning real estate in more than one state, a properly funded trust may also help avoid separate probate proceedings in multiple jurisdictions. Again, state law and asset type matter, so this must be reviewed with counsel. A trust document can be perfectly drafted and still fail to avoid probate for assets if they were never connected to it. This is called the funding problem. Funding may involve retitling real estate, taxable investment accounts, bank accounts, business interests, or other property into the trust. It may also coordinate your beneficiary selections or using assignments for certain personal property. The best method depends on the asset and its legal and tax consequences. Now, retirement accounts usually are not simply retitled into a revocable living trust during the owner's lifetime. Instead, beneficiary designations must be coordinated carefully because naming a trust can affect after-death distribution rules and taxation. One practical way to test this is to create an asset inventory with 4 columns like you see here. What is the asset? How is it owned? Who receives it at death? And which document or designation controls the transfer? If you cannot complete these 4 columns confidently for all of your assets, then your account might not be fully coordinated and there may be some hidden gaps. Imagine Robert and Elaine, both age 67. They own a primary residence, a vacation property in another state, taxable investments, retirement accounts, and an interest in a family business. They created their wills years ago and recently created a revocable trust, but only their primary residence was transferred to it. So what happens if Robert dies first? If Robert dies first, some assets may pass by beneficiary designation, others by joint ownership, one property through the trust, and the remaining individual owned assets through probate. The family may still face an additional probate proceeding for the out-of-state property. The lesson is not that their trust failed, their implementation failed. Your estate plan is not complete when documents are signed, it's complete when your documents, assets, and people responsible for carrying out your plan are aligned. Now let's take a look at minimizing taxes and how to choose the right trust for the right purpose. Here you'll discover revocable versus irrevocable trusts and their tax differences, trust strategies for estate tax, income tax, and capital gains, and balancing tax savings with access, flexibility, and control. When someone says, I want a trust to reduce taxes, the first response should be, which tax? Are we discussing income tax on trust earnings, federal estate tax, an estate or inheritance tax, generation skipping transfer tax, the taxation of retirement accounts, capital gain tax, property tax, or gift tax? These are all different systems with different tax rules. A strategy that reduces your estate could increase your capital gain tax. A strategy that removes future appreciation from your estate may require surrendering access or control. A trust that protects an inheritance for your child might reach the highest federal income tax bracket more quickly than an individual taxpayer, depending on how the income is retained and distributed. This is why sophisticated planning begins with a diagnosis, not a product. First, identify the tax exposure, quantify where it is possible, compare it with non-tax goals, and only then evaluate structures. A revocable trust generally allows the creator to retain control and change the plan. For federal income tax purposes, it is commonly treated as a grantor trust, meaning the creator is generally treated as the owner of the trust assets, and they report the income. Because control and beneficial enjoyment are typically retained, the assets are generally still considered in the creditor's estate for estate tax purposes. An irrevocable trust cannot simply be changed or revoked at will under its terms, although modern trust law may provide limited modifications under certain circumstances. Its tax treatment depends on the powers retained, beneficiaries, and the trust language. Some irrevocable trusts are grantor trusts for income tax purposes, and others are separate taxpayers. The central trade-off is control versus potential planning benefit. If you retain every right, every dollar access, every power, it's difficult to argue that the property is no longer yours for transfer tax purposes. That doesn't mean irrevocable planning is always appropriate. It means that the family must understand the trade-off. And a sound advisor would be willing to explain not only the potential benefit for your unique situation, but also what you give up, what could go wrong, and what ongoing upkeep is required. For families with potential estate tax exposure, irrevocable trusts may be used to transfer assets, future appreciation, life insurance benefits, or business interest outside the taxable estate when structured and administered correctly. An irrevocable life insurance trust may own life insurance so that policy proceeds can provide liquidity to your beneficiaries or estate obligations without being included in the insured's estate, assuming the ownership, transfer, timing, and administration rules are all followed. A spousal lifetime access trust may allow one spouse to make a completed gift to a trust, benefiting the other spouse and potential descendants. This may move future appreciation outside of the donor spouse's estate while preserving indirect family access through the beneficiary spouse. But divorce, premature death, reciprocal trust concerns, and loss of access must be evaluated carefully. The grantor retained annuity trust, intentionally defective grantor trust, charitable remainder trust, charitable lead trust, and other advanced structures may be useful in the right circumstances. Their names matter less than their economics. What is the transferred? What is retained? Who bears the tax? What assumptions must be true? And how the plan performs if markets or family circumstances change. So keep this in mind. Advanced strategies should not be implemented just because they sound sophisticated. They should only be considered when the expected benefit justifies the complexity, cost, and reduced flexibility. One of the most important planning concepts is basis. Basis is generally the starting value used to calculate gain or loss when property is sold. Property received as a lifetime gift generally carries over the donor's basis for purposes of calculating gain, subject to specific rules. Inherited property generally receives a basis tied to the fair market value at death, subject to exceptions and elections. So why does that matter? Suppose you own a highly appreciated stock or piece of real estate. Transferring that asset out of your estate during your life may reduce the estate tax exposure or remove future appreciation. But if the asset will not be included in your estate at death, then your family may not receive the same basis adjustment that could apply to inherited property. Therefore, the goal should not be pay the least estate tax in isolation. The goal should be to reduce the family's total tax burden while preserving the desired level of control, income, liquidity, and protection. So this is where tax modeling becomes incredibly valuable. Comparing the multiple scenarios of retaining the asset, gifting it outright, transferring it to a trust, selling it, diversifying it, or using a charitable strategy. The right strategy for you may change based on the variety of factors. So you got to make sure you calculate the expected growth, time horizon, state law, cash needs, and the size of the taxable estate. Trust taxation is not simply lower or higher. It depends on whether the trust is created as owned by the grantor, whether it distributes income, what type of income it earns, and who receives the distribution. Non-grantor trusts may reach compressed federal income tax brackets quickly. Distributions may carry distributable net income to beneficiaries who may then report the taxable income. Capital gains may remain taxable to the trust unless the document, state law, and administrations support a different result. Administrative discipline matters too. Separate records, tax returns when required, trustee decisions, notices, valuations, and documentation may be necessary. A trust that is ignored after signing can create more risk for you, not less. So be cautious of anyone promising that a trust automatically makes ordinary income disappear. The IRS emphasizes that substance, not merely labels, controls taxation. Before selecting a trust, ask yourself these 5 questions. What problem are we solving? Which assets are best suited to the strategy? What control or access must be retained? What tax and legal assumptions are required? Who will administer the trust over time? If those questions cannot be answered clearly, then the strategy is not ready for implementation. Now consider this question. Which is your highest priority? Control, tax efficiency, protection, privacy, or family governance? Effective tax minimization begins with the right questions, balancing savings, control, cost, and complexity to preserve more of your family's wealth. Let's turn our attention to protecting your legacy, coordinating your trust with your financial plan. That will cover aligning your trust with retirement accounts and beneficiary designations, protecting inheritance for spouses, children, and future generations, and coordinating asset ownership, insurance, gifting, and incapacity planning. Your will and trust do not necessarily control every asset. Retirement accounts, annuities, life insurance, payable on death accounts, and transfer on death accounts follow their beneficiary forms or registration instructions. That creates a common failure point. A trust may say that assets should be held for a child until age 35 as an example. But a retirement account naming that child directly may become available under the rules governing that account. A former spouse may be still listed. One child may receive a large account outside the trust while others share the probate estate, unintentionally creating an unequal result. For retirement accounts, beneficiary planning also affects after-death distribution timing and taxation. Naming an individual, a spouse, a charity, or a trust can produce very different outcomes. Trusts named as retirement beneficiaries require specialized drafting and administration. A coordinated review should compare every beneficiary designation with the distribution plan in the legal document. This is a simple step with enormous leverage. Taking assets outright is simple, but simplicity is not always protection. An outright inheritance may be exposed to the beneficiary's creditors, divorce, poor financial decisions, addiction, immaturity, disability, benefit rules, or outside influence. A continuing trust can allow a trustee to manage assets for a beneficiary under standards you choose. The trust may support health, education, maintenance, and other support areas, permit discretionary distributions, provide incentives, or create a framework for family governance. For a responsible adult child, the trust does not have to feel punitive. The child might serve as co-trustee or investment advisor or receive increasing control over time depending on the legal design. The goal is to balance independence with protection. For blended families, trust may support a surviving spouse while preserving remaining assets for the children from a prior marriage. But the plan must address investment authority, distribution standards, use of residences, trustee selection, and communication. Vague language can turn a protective structure into a source of conflict. Take this into consideration. Your trust strategy and overall estate plan should reflect the family's shared identity, values, and not merely divide the property. Estate planning is not only about death. A period of incapacity may create immediate financial and personal decisions, paying bills, managing investments, operating a business, maintaining property, supporting dependents, and coordinating care. A revocable trust can provide a mechanism for a successor trustee to manage trust assets. A durable financial power of attorney may address assets outside the trust and other legal matters. Healthcare directives and medical powers appoint decision makers for your treatment and end of life choices. These documents should all work together. The definition of incapacity, the method for determining it, the authority granted, and the people selected should be reviewed by you very carefully. Here's another reflection question. Who could step in tomorrow and would know what to do? A name on a document is not the same as a prepared decision maker. A well-designed estate plan will also ask where the cash will come from. Will your estate have liquidity to pay taxes, debts, expenses, equalize inheritance, maintain real estate, or buy out a business interest? Life insurance may provide liquidity, but ownership and beneficiary structure affect control and potential estate inclusion. Gifting may reduce the estate, but it may also reduce personal liquidity, transfer basis, or create inequity among beneficiaries. Business succession may require buy-sell agreements, valuations, and funding arrangements that coordinate with the trust. Your plan could look perfect on paper and still fail without the proper protection to carry it out. The strongest plans are stress tested. Let's take a look at these questions and think about how you'd answer them. What happens if a spouse dies early? What happens if you both live into your 90s? What happens if the market declines? What happens if a business can't be sold? What happens if a beneficiary divorces? What happens if the proposed trustee is unavailable? In a broader sense, merely what planning cost is not the only thing to consider, but also consider what resources do you have. What's the cash, the insurance, the time, the expertise, the family capacity? Are all of these available to make your plan work? The trustee may control investments, distributions, tax filings, records, and communication with the beneficiaries. So selecting a trustee based only on birth order or family closeness could be a mistake. Consider their judgment, availability, financial skill, impartiality, demographic location, family dynamics, and willingness to serve. A corporate trustee may offer continuity and professional administration, while an individual trustee may know the family well. A co-trustee arrangement can combine strengths, but may also create delays or conflict. So communication matters too. You don't have to disclose every dollar, but key family members should understand the plan's purpose, where the documents are located, who has authority, and whom to contact. True protection means keeping every part of your plan current, funded, and aligned so that your wealth, wishes, and loved ones remain protected when it matters most. At least periodically and after major life, tax, family, or financial changes, review your legal documents. Asset ownership, beneficiaries, life insurance, business agreements, trustee choices, and tax assumptions together. A plan that does not evolve with your life may no longer protect the wealth you built. Finally, let's take a look at turning knowledge into action. We'll look at the top 5 most common trust and estate planning mistakes to avoid, questions to ask before creating or updating a trust, and your next steps, which are reviewing your estate plan for hidden risks and opportunities. This is where we bring the major risks to your plan together. The first mistake is assuming that a will avoids probate. A will generally directs the probate process. It does not by itself remove the assets from that process. The second is creating a trust but failing to fund or coordinate it. The third is assuming every trust reduces taxes. The fourth is focusing on estate tax while ignoring basis, income tax, liquidity, and retirement account rules. The fifth is treating the plan as a one-time legal transaction instead of an ongoing financial and family process. If you remember nothing else, remember this. Financial documents, assets, beneficiary forms, your tax strategy, and elected decision makers all must tell the same story. As a practical next step, ask yourself these questions. Do I know which of my assets will go through probate? Is my trust fully funded? Are beneficiary designations current and consistent? Should my chosen trustee act effectively? Have appreciated assets been reviewed for basis and estate tax trade-offs? Is there enough liquidity? Does the plan address incapacity? Have my attorney, tax professional, and advisor coordinated their recommendations? You do not need to solve every issue today. However, you do need to know which issues require your attention while you're still able to take action. Remember this. At the beginning, I asked you to rate the coordination of your plan from a 1 to a 10 and write it down. Now consider that number again. Did your score stay the same? Did it rise because you recognized strengths in your plan? Did it fall because you discovered questions that have not yet been answered? Either result is useful because clarity is the first step towards better planning. So here's your last reflection question. What is the single most important gap you want reviewed? For some of you, today's teachings may simply confirm that your plan is in good order. For others, it may have revealed a gap between what you want and what your current structure can actually deliver. So now it's time to take action and review your plan for hidden risk and opportunities. If you would value a second set of eyes, we're offering a custom estate planning risk and opportunity report to our webinar students so you can get a clear today on your personal areas of opportunity and see exactly where you are left open to risk. This report shows you how to organize your financial picture, identify probate exposure, review trust funding, and uncover dangerous gap areas, as well as prioritizing your next steps. The most limited resource in estate planning is not tax exemption or legal technique. It's the opportunity for you to make thoughtful decisions while you're healthy, informed, and able to communicate your wishes. So thank you for investing an hour of your time today in your family's future. The 3 steps to receive your custom report are this. 1, reserve a time with an estate planning expert in order to gather the required information required to create your report. 2, collect copies of your investment statements, your most recent tax return, and a list of all your assets. And 3, write down your estate planning concerns, goals, and objectives. Because we prioritize creating high-quality reports for you, this link will be available for only 24 hours following this presentation. To get started, simply scan this QR code with your phone's camera to access the link to reserve your free report, or type directly into your web browser the address at the bottom of the screen. These spots do fill up fast, so pause here if needed so you can make sure your spot is reserved. Thank you again for joining us. For additional questions involving your personal assets, beneficiaries, taxes, or legal documents, please email us at education@stripmatterwealth.com. You guys have a wonderful day and happy planning.